Hello friends, welcome to my channel. Today I will take you through a comprehensive step-by-step guide on closing of books of accounts, a crucial month-end procedure. This video is specifically designed for CA students, graduates and professionals looking to join our team. In this comprehensive video, I will be covering the following key topics to help you master the month-end closing process. First one is month-end closing plan. Second, accounts payable and accounts receivable. Third, payroll entries. Fourth, revenue recognition. Fifth, inventory valuation. Sixth, provision for expenses. Seventh, fixed assets. Eight, other closing activities. And at the last, preparation of financial statement. Month-end closing plan. This is very important for an organization, specifically the finance team, so that all the activities are planned very well before the financial statement is prepared. The general accounting team or R2R, record to report team, is responsible for closing the books. And R2R team will share the month-end closing plan to respective stakeholders who are responsible for closing of books. That means every stakeholder should know on what data to be provided and on which day to be provided to the R2R team. Or if they have to post any entry in the accounting system, they should ensure that they are doing all those entries in the system on the specific date mentioned in the month-end closing plan. The month-end closing plan to be set 1 week before so that respective team members can plan their activities. The month-end closing plan should be based on deadlines specified by the management. So it depends on the management. Few management may require the result on first working day. Few management may give few more extra days like fourth working day, fifth working day. So based on the management's requirement, you have to plan your closing plan so that you should not rush on the last day to prepare something, right? It should be well planned so that all data is captured, entries are posted, reviews are happening properly before you publish your result. If the reporting has to be completed by working day 4, example, then the month-end planning should provide the activities to be completed on working day 1, working day 2, working day 3. So every day what activity to be completed should be captured in the plan. Few companies plan their closing activities before end of the month as well, right? Certain activities like payroll activities or any specific activity the company want to close before last day of the month, they can still do it and they can put as part of their month-end planning. Now let's take an example how the month-end closing plan looks like. So you can see in this table here, you have the date in the left side, working day, the activities which you want to close on those working day, and then the responsible person. Sometimes you may add one more column as the departments, who are responsible for that. So there is no specific rule for the month-end closing plan. It depends on the nature of the business, depend on the finance team's requirement, and you can draw the closing plan with discussion with the respective stakeholders as well, so that you both are aligning. It's not happen that you pressurize someone and they are not able to support you. Accounts payable and accounts receivable. Closing of accounts payable and accounts receivable is very important, and this processes deals with the operational activities of the company, right? So before you lock your system, the first activity what has to be closed is accounts payable and account receivable processes. So let's see what actually we need to close. So for the accounts payable part, all recurring cost invoices has to be accounted before month end, right? So for example, like rent or electricity, these are all recurring expenses, and we know that invoice will definitely come in the month. So the accounts payable team has to ensure that all these recurring expenses are accounted before 30th and 31st of the month. Next, accounts payable team has to follow up with the respective business team to ensure all invoices are submitted on time. It's not happen a situation that the invoices are not coming on time. Even though you have an option to take provision for expenses for closing the books, but still it is recommended that the accounts payable team follow up with the respective businesses to ensure that the invoices are coming on time and accounted on time. All goods receipt note pending for invoice accounting has to be reviewed, and all accounting has to be closed for that. The last one is very important. All foreign currency invoice outstanding has to be restated as per the closing exchange rate, and any difference with actual liability has to be accounted as unrealized forex loss or gain, right? So any foreign currency liability has to be restated as per the accounting standard requirement. The closing rate can be considered either if you are in an MNC company, then the closing rate declared by the group company, or else if you are an Indian company, you can take the RBI or any specific bank rate and restate your liabilities. Coming to the accounts receivable part, all recurring invoices has to be accounted before month end, that is 30th 31st. That means if you have an agreement, you are giving a service or you are selling any product, the invoice for that has to be raised. You can't keep it pending. Second, align with project managers if any project cost has to be billed to the customer before month end, because the finance team will not have all the information, right? It may happen that there may be business controlling team who will be monitoring these projects, but you should align properly with them to see that the billing part is not missed before the month end. So if something is to be billed, you have to ensure that it is billed on time. All payments received from the customer has to be applied correctly with respect to invoices. So mostly we have seen that on the last day, lot of payments will come from the customer, and you should ensure that before you lock the system, accounting system, you post all the entries correctly, and that too applying to the correct invoices. Next one is all deduction by the customers has to be accounted like TDS penalty. So if there is any deduction, the proper analysis has to be done that why the amount has been short paid by the customer, and all necessary entries has to be posted. So if there is a deduction towards TDS, then you have to account TDS receivable as well. And the last point is equal to accounts payable. So all foreign currency invoices outstanding has to be restated as per the closing exchange rate, and any difference with actual receivable has to be accounted as unrealized forex loss or gain. So any amount which is outstanding from a foreign entity or outside India, and you have not received that as on the reporting date, then you have to restate as per the closing rate. Difference has to go to unrealized forex loss and gain. Payroll entries. All payroll entries has to be closed and all payroll ledgers has to be reconciled. This is one of the very important reconciliation which need to be performed by the finance team. Salary journal voucher. Payroll team has to share salary JV to the R2R team, and as salary data is confidential, the payroll team will share the journal entry to be posted in the accounting system. Once the entry is posted by the R2R team, the salary payable balance has to be reconciled with the actual salary paid as per the amount debited from bank statement. And any difference in the reconciliation has to be discussed with the payroll team, and necessary adjustment entries has to be posted if it has been missed in the original entry, right? So this is very important because the liability created for salary has to match with the payments. Sometimes it may happen that any new joinee who has joined and is given a wrong bank data, there could be a reversal of the salary amount. But in that case also, we have to ensure that we are reconciling, and to that extent, whatever amount has been bounced back, we report as salary payable amount, which will be paid subsequently. Statutory liabilities. All statutory liabilities relating to payroll has to be accounted. Example like Provident Fund, both employers and employees contribution. TDS, tax deducted source as per the Income Tax Act. Professional tax, National Pension Scheme if there is any deduction or there is a contribution by the employer, all has to be accounted. Provision for variable salary component. So today if you see there are two types of salary which is paid. One is the fixed component to the employee, then there will be a variable component which may be dependent on the company's performance or the individual performance. In that case, all provisions relating to variable salary component has to be accrued if it is not due for payment, right? Certain companies make this payment quarterly, certain companies make this payment annually, but you have to account it every month, ensuring that the correct cost is reported every month. And the examples of variable salary components are like statutory bonus, company bonus, commissions to sales employees, short-term incentives to employees, and all that. Recognize whether you are working in manufacturing company or in the service company, revenue recognition is one of the most important process which need to be reviewed during the month close. So revenue has to be accounted based on guidelines specified as per IFRS 15 or Ind AS 115. So what the finance team is going to do for the revenue recognition, and that too during the month end. So they have to check risks and reward transfer to buyer, right? Because one of the condition in Ind AS 115 or IFRS 15 says that unless the risk and reward is transferred to the buyer, the manufacturer or the seller can't recognize the revenue. So let's see what and how to check. So as for IFRS 15 and Ind AS 115, revenue can be recognized only if the risk and reward on the product has been transferred to the buyer. To examine whether the risk and reward has been transferred or not, the R2R team has to check the contracts with customers and identify the Incoterms agreed with the customers. Risk and reward transfer are as per below conditions. A. Incoterms. X work. So if the Incoterms is X work, then when the risk and reward will transfer? When the goods move out of the factory gate. But if the Incoterms are FOB or CIF, specifically used in case of export of goods, in that case, date on which the bill of lading is issued by the shipping carrier is the date on which the revenue can be recognized. So R2R team has to examine the Incoterms and check whether on the reporting day the goods moved out of the factory gate or not. Second, if it has moved out, whether the risk and reward has been transferred or not. Coming to the third point, R2R team has to reconcile all invoices raised during the month with the material outward register and ensure that all XOR sales, the goods are moved out of the factory gate. In case of export, the bill of lading date has to be checked, right? So all this is the process what the R2R team has to check during the closing. Now, what accounting entries you are going to post if the revenue has to be reversed because the risk and reward has not been transferred? The first entry to be posted is sales debit to customer. So the entry posted during invoice has to be reversed first. Then the correlated cost of goods sold also has to be reversed. That means you have to debit inventory and credit cost of goods sold. Here one point you have to keep in mind that the GST liability is not reversed as GST law doesn't follow the criteria of revenue recognition. That means if the invoice is raised, you have to pay the GST to the government. Second, all expense provisions accounted relating to the above revenue has to be reversed as revenue has been reversed. So what is happening here? Because the revenue has been reversed, all related cost for that revenue has to be reversed. For example, like you created a warranty provision, commission to dealer. So all this has to be reversed because the base, that is the revenue, is reversed now because the risk and reward has not been transferred. Now let's try to understand how the revenue recognition is done in case of service industry, right? That means your revenue is generated by selling service to your customers. So all service invoices has to be reviewed and checked whether revenue to be deferred if the service is not yet delivered. That means you have raised the invoice, you have recorded this as a revenue. Now question is whether you should recognize completely 100% now or you need to defer this revenue as per the accounting standard requirement. So what you are going to do as part of the R2R team, as per the contract, if the obligation towards the customer is for a longer period, then the revenue has to be recognized for that period. For example, annual maintenance contract, generally called as AMC, is for certain period like 12 to 24 months, right? The invoice raised during the month has to be deferred for the AMC period and to be amortized every month till the end of the AMC period. That means if the AMC is for 12 months, then the revenue has to be split to 12 months. If it is for 24 months, then it has to be split to 24 months. You can't recognize completely the value of the invoice in the same month, right? Because your obligation is still there towards the customer for next 12 to 24 months. Advance received from the customer should not be accounted as revenue unless the obligation is completed by the seller, right? You can't simply record because the money is received or because the money is non-refundable. You can't go ahead and record as revenue because your obligation towards the customer is not completed. Now, accounting entries for deferred revenue. Okay. So what accounting entries you're going to do? The first entry is that you completely reverse the amount what you have booked today for the complete invoice, right? So what is the entry you're going to post now? Sales, or you can say service income account debited to deferred revenue, right? So whatever revenue you have booked today in the books, you are deferring it completely, right? And at the month end, you are going to post the entry only for the portion what should go to revenue based on the split accounting or based on the period the service is going to be provided. So deferred revenue account debited to sales or to service income account. Now, what you need to note here, that proper control accounting or control workings should be there to check that no specific month revenue entry is missed, right? And in no situation the revenue is booked excess in compared to deferred revenue accounted. It's not happened that you're going on posting deferred revenue to income, but there is no track that the deferred revenue was created for X amount and you're going on posting entry for X plus Y, which is not correct. Inventory valuation. Inventory valuation is one of the critical activity for month close, and it has to be calculated accurately as the profitability will change based on the closing stock valuation. So you have to double check, you have to ensure that the formulas, the rates considered for valuation of closing stock is accurate. Now let's see what is the role of the R2R team in relation to valuation of inventory. The R2R team has to ensure that the inventory is valued as per the company's policy. Okay, so it could be either FIFO, weighted average, or specific identification method as defined under accounting standard. So it is the choice of the company to select which method to be applied for inventory valuation. Most of the manufacturing companies follows standard costing for inventory valuation to ensure proper control on inventory cost. However, standard costing is not allowed as per accounting standard. Hence, the inventory has to be valued as per company's policy. The FIFO method or weighted average method has to be applied, but the FIFO and weighted average rates has to be applied on the closing stock. And the difference between standard cost has to be accounted so that actual cost is reported in the books of accounts, right? Now, valuation of inventory as per company's inventory policy. Let's take an example here. You can see here inventory X, Y, Z. Quantity, you have 10 in case of X, 15 in case of Y, 12 in case of Z. And the standard cost maintained in the accounting software is 542 for X, Y, and Z. Cost as per the accounting system is 50, 60, 24. That is quantity multiplied with standard cost. Now, the inventory cost as per the books is 134, but you can't report that because standard cost is not allowed as per the accounting standard. Then what you need to do, you have to calculate as per the company's policy, that is inventory policy. So inventory policy allows only FIFO, weighted average, specific identification method, right? So for example, if the company is following your weighted average method, so weighted average rates from the system you have to download, and you can see here the rates are 4.5, 3, 2.5, and when you multiply with the quantity, the cost of weighted average is coming around 120, right? So what you need to do now, you have to see that the difference is accounted so that the closing stock is valued at 120 instead of 134, correct? So what entry you are going to post? Cost of goods sold account debited 14 to inventory 14, because 134 is higher by 14 rupees compared to 120. So you're reducing the inventory and increasing the cost of goods sold. Valuation of finished goods. If the company follows standard costing for finished goods valuation, then at month end, it has to be valued based on company's inventory policy, similar to what we saw in the previous slide. So standard costing is good for controlling, but it is not allowed to value the inventory as per the accounting standard requirement. So whether it is raw material, WIP or FG, in all the three cases, you can't follow standard costing. The bill of material, that is the list of materials used in the finished goods, has to be revalued as per the FIFO weighted average, and any difference to be accounted. And how it will be accounted? It will be adjusted with the finished goods value. The way we checked one example in the previous slide for raw material, the similar applies for finished goods. One interesting thing here is that for standard costing, for variable and fixed cost, that is the overhead, the company would have taken a standard cost for that as well. So what you need to do here, the variable and fixed overhead has to be identified at actuals, and the same has to be allocated to the finished goods, correct? Then only you will get the complete cost of manufacturing of the finished goods. Now, cost or NRV is very important. Why? Let's see. If the inventories are sold below the inventory cost, then it has to be adjusted to the net realizable value. So inventory should not be reported at higher value if the same is not realizable by selling to the customer. That means if the inventory cost is 100 and you are selling that product in future at 90, you can't report it at 100 because the realization is only 90. Hence, you have to reduce the inventory valuation to 90. On the closing date, the R2R team will examine all future order book and check if any FG will be sold lesser than the cost. If such situation is identified, then the R2R team has to ensure that the inventories are downgraded and the value is as per the sales agreement, not the value as per the cost of production. Now, valuation of work in progress goods. How the valuation is done for WIP? R2R team has to get status of work in progress goods on closing date from the factory manager or the business controller. Inventory has to be valued based on the percentage completion of finished goods. So you will be having all your cost, variable cost, fixed cost, overheads. The same has to be allocated to WIP based on the percentage completed on the last day status. Provision for expenses. So let's see what are the items for which we need to take provision for expenses. And this is very important because your profitability depends on the provision for expenses. So if you take excess provision, your profit will come down. If you take lower provision, your profit will go up. So management has to ensure that the provisions considered in the books of accounts are accurate and no direct entries or no direct expenses are taken without any backup. That means sometimes it happened that to adjust your budget, you take some ad hoc provisions, which is not correct. So you have to ensure that no ad hoc provision is provided without any backup. The first one is unaccounted invoices. All invoices which are with the accounts payable team but not accounted has to be considered for provision for expenses. Provision has to be considered for all disputed invoices as well. Business team may share data for the services received from the vendors, not invoiced yet or received from the supplier. Provision for those services has to be accounted. Ensure that there is a valid order or contract with the vendor to support the accounting entry. So if there is no PO, there is no contract, then it is very difficult to support your entry, right? Because we don't know whether the service has been received or it is just the business is estimating that they have received the service. Account provision for cases where GRN is completed but invoice not submitted to finance team. Review high value contracts and ensure sufficient provision is accounted if there is any requirement as per the contract, right? Next, provision for tax demands. Account provision for all tax demands which the company believe to make the payment in future or there is no certainty that the case may be in the favor of the company. So in those cases, you have to post all the accounting entry for the demands. Provision for customers or dealers. All provision relating to sales of goods and benefits for dealers has to be accounted. Example, bonus and commission to dealers, provision for warranty and rebates, commissions and targets. Correct? That is how all benefits will flow. But if it is not due for payment, you have to create the provisions for these third parties. Provision for employee cost. All retail cost relating to employees has to be considered for provision. For example, gratuity, leave encashment, ESOP, and you need not do the actual valuation every month. Few companies they do the actual valuation every quarterly. Few companies they do once in a year. So if your company practicing to do once in a year, then you can ask your actuary to give an estimated entry for every month. Based on that, you can post that entry. Second point here is that any specific benefit provided to the employee has to be considered as provision if the payment is not yet made. Example, retention bonus. So if you have given any commitment to your employee by issuing a letter, then in that case you have to accrue the provision for it. Provision for legal matters. R2R team has to get data from legal team and if required to consider provision for cases where the company believe that there could be payment to the third party. Then in that situation, you have to estimate the best estimation what you can do as per the cases filed by the customers or by any third party. You have to estimate and take a provision for it. Goods in transit. Data from all supplier on goods in transit should be available as on closing date. Nowadays, there are systems which captures all movement of the goods. For all goods which are in transit, an accounting entry for the same will be posted if the risk and reward on those goods has been transferred to the company on the last day of the month. Fixed assets, depreciation posting. So the R2R team has to ensure that depreciation posting is completed at the month end. Okay, that is very important. It's not happened that you miss the depreciation. And then check that the accounting system has posted depreciation for all assets available in the fixed asset register. It's not happened that there is some bug or there is some error and certain assets are not depreciated. Monitoring of capital work in progress. It is the role of R2R team to ensure that all assets reported as capital work in progress are not ready for use. Correct? You have to justify. You have to ensure that assets which are not ready for use are only reported. Because if assets are ready for use, you have to capitalize and depreciation should start on that. And confirmation from respective business has to be obtained on the status of suitable IP. So this helps you as a backup because as finance team, you may not know the use of the assets. You'll be not knowing that where it is used and for what purpose it is used. So it is always good that you get the confirmation from the factory, from the business controller or plant manager to see that the assets are not really used. Assets to be written off. If any request has been received from the business to write off any certain assets, then ensure that before you close your books, you account those and write off the assets from the fixed asset register. Impairment of assets. If the business is not earning profit, then R2R team will be doing the assessment of impairment of assets. Generally, the discounted cash flow will be compared with the carrying value of the assets. And if it is lower, then the impairment provision has to be accounted. Correct? So the carrying value is higher and the discounted cash flow is lower, then you are overstating your assets. Hence, you have to impair the asset value. Other closing activities. Now let's understand what are the different other activities you need to perform before you close your books or before you start your financial statement. The first one is BRS, Bank Reconciliation Statement. Ensure all difference between books and bank statements are reconciled. All reconciled items are accounted before closing of the books, right? Don't leave any entry pending in the bank reconciliation statement unless something is very gray or you don't understand what is that, which can be investigated in subsequent month. Lease accounting. Ensure RO assets and lease liabilities created for all long-term leases as per IFRS 16. So if there is any contract in that month, ensure that the RO asset is created. Okay, don't forget that. Rent paid during the month has to be reconciled with the amortization of RO assets and lease liability. So the depreciation from RO assets, the payment going from lease liability, all this need to be reconciled so that the rent paid during the month is compared and it is checked whether it is accurate or not. Cost allocation. If any department cost has to be allocated to certain departments, then ensure that the cost is allocated as per the allocation key. Hedge accounting. Ensure all hedge accounting closing entries are posted. Mark to market provision has to be taken for all hedge assets. Provision for tax and deferred tax accounting. So provision for tax has to be calculated based on the country's tax law. All allowed, disallowed, permanent difference, temporary difference, all has to be adjusted and provision for tax has to be created. At the same time, for all the timing difference, deferred tax has to be created and it has to be adjusted with the previous month's entries as well. So if last month there is a deferred tax asset and you have to create a deferred tax liability, similar entries has to be posted so that the actual entries are posted in the books. Now I'll talk about preparation of financial statement. First, I'll start with profit and loss account. Let's see how the profit and loss account looks like and what is the meaning of profit and loss account here. This account helps you to determine the profit earned by the company for the accounting period, right? So it will be always for a period. It can be 1 quarter, it can be 1 month, it can be for the full year. And how it looks, this is how it looks now. You have income, revenue from operations, other income. So all your income will be reported. And then you have the total income here, less expenses. What are the expenses you will have? Cost of sales, employee expenses, depreciation, other expenses, other gains, finance cost, and then you will have the total expenses. The difference between the total income and total expenses is profit before tax. And from profit before tax, you have to reduce the tax amount. That is the tax what you're going to pay as per the country's law. And after that amount, you will have profit after tax. So this is how the profit and loss account will look like. Now let's see how the balance sheet is prepared. So balance sheet will have assets and liability. So here I am showing you the assets here. Assets will have non-current assets first, plant property and equipment, capital work in progress, right of use assets relating to lease, financial assets, deferred tax assets, other non-current assets. So all non-current assets will be reported first. Then you will have the total non-current assets. Then you will have current assets, inventories, trade receivable, cash flow from cash equivalent, other financial assets, other current assets. So the difference here is that non-current assets are assets which the company has the intention to keep it in the balance sheet for more than 12 months, right? And no intention to liquidify or no intention to sell it. Whereas in current asset, the company expect that this all get converted into cash within a shortened period that is less than 12 months. Then the total of non-current assets and current assets will be your total assets. Now coming to the liability side, you have equity, share capital, and reserve and surpluses. This is generally called as net worth of the company. So total equity you will have after adding up your share capital and reserves. Then you will have non-current liabilities similar to non-current assets. That means liability which the company is going to pay after 12 months and not to be paid immediately. So you may have borrowings which may be a long-term borrowing. Lease liability which you are going to pay after 12 months will be classified under here. Then you will have total non-current liabilities. After that, you have to report all current liabilities. That means liabilities which you are going to pay within a shorter period and which is generally less than 12 months. So you have borrowings, trade payable, MSME vendor, lease liabilities, other financial liabilities, and then you have total current liabilities. So your equity and your liability has to be shown total as liabilities. You have to ensure that the balance sheet tallies. Your total assets has to match with your total liabilities. So this is all about closing processes. Different company follows different processes, and the closing processes differs from industry to industry, like manufacturing versus service, or maybe in banking it is completely different because the financial statement prepared there is different than the format what I showed you here. Insurance company will have a different format and different process. So I tried my best to provide what are the best processes applied. There, it's not that this is the complete list. There are different other activities also based on the industry could be used. So thank you for watching this video. Please subscribe to my channel to get more videos on that. Share with your friends so that they understand the closing process. Thank you.